Today we will discuss about the Basel norms. We all know that one of the important criteria that banks all over the world have to follow is the Basel norm. What are the various aspects and what are the various norms included in the Basel norms are explained in this section. Basel, as the name shows, is a city in Switzerland. It is also headquarters of Bank for International Settlement (BIS). Basel norms, or popularly known as Basel Accords, are international banking regulations issued by the Basel Committee on Banking Supervision. That is, these Basel norms are issued by the Basel Committee on Banking Supervision and it is known as Basel norms or Basel Accords. This Basel norm or Basel Accords is an effort to coordinate banking regulation across the globe. That is, one of the important objective is to coordinate the banking regulation across the globe, and the goal is strengthening the international banking system. That is, the effort is or its objective is to coordinate banking regulation across the globe, and its goal is strengthening the international banking system. It is the set of agreement by the Basel Committee of Banking Supervision which focuses on the risk to bank and financial system. That is, the Basel Committee on Banking Supervision focuses mainly on the risk and the financial strength of the financial system, and the Basel norms are the set of arrangement by the Basel Committee of Banking Supervision. Basel norms are international banking regulation issued by Basel Committee on Banking Supervision, as we have seen, and the Basel Committee on Banking Supervision consists of representatives from central banks and regulatory authorities of 27 countries, including India. We are also a member of the Basel Committee on Banking Supervision. The Secretary or Administrative Office is located at the Bank of International Settlement headquarters in the city of Basel in Switzerland, hence the name Basel Norms. The Basel Committee has issued 3 sets of regulation as of 2018 known as Basel I, Basel II and Basel III. That is, so far 3 Basel Accords or norms were introduced by the Bank for Basel Committee of Banking Supervision. They are Basel I, Basel II and Basel III. That is, this name arose from the name of the city Basel in Switzerland. Second one, this Basel norm mainly aims at strengthening the international banking system, and second one, its goal is or its objective is to coordinate banking regulation across the globe. And a brief history is given here. The Basel Committee, initially named the Committee on Banking Regulation and Supervisory Practice, was established by the central bank governors of the Group 10 countries at the end of 1974 in the aftermath of the serious disturbances in the international currency and banking markets. That is, it was established in 1974. The name was not by Basel Committee. Initially the name was the Committee on Banking Regulation and Supervisory Practices, and it was introduced by G10 countries in 1974 when the countries faced the problems of international currency and banking market problems. The committee headquartered at the Bank for International Settlement, Basel, was established to enhance the financial stability by improving the quality of banking supervision worldwide and serve as a forum for regular cooperation between its member countries on banking supervisory matters. After all, the Basel norm was introduced, and the committee's first meeting took place in February 1975, and the meeting have been held regularly 3 or 4 times a year. The Basel Committee has expanded its membership from G10. Earlier it included G10 only, G45 institutions from 28 jurisdictions. Starting with the Basel Concord Code Act, first issued in 1975 and revised several times since then. The committee has established series of international standards for banking regulation, most notably its landmark publication of the Accords on Capital Adequacy, which is commonly known as Basel I, II, and III. That is, Basel Concords were started in 1974. Later, Basel Accords were published, namely Basel I, Basel II, Basel III from 1988 onwards. This is the preface. Earlier the name was the Committee on Banking Regulation and Supervisory Practices. Later on in 1975 they started they used the name Basel Committee, Basel Concordat. After that, they started using the name Basel Norms from 1988 with the Basel Accord, with the starting of the use of the Basel Accords or Basel Norms. A brief explanation about the various Basel norms are given here. First one is Basel I Accord or Basel I norm. Basel I norm was introduced in the year 1988. It focused primarily on credit risk faced by the bank. They mainly focused on the credit risk faced by the bank. As per Basel I, all the banks were required to maintain capital adequacy ratio of 8%. As per this, the CAR, that is the measuring rod of this, the strength of the financial system or the marketing regulation. We will discuss about the capital adequacy ratio in the next slide, about 8%. And India adopted Basel I in 1999. It was introduced in 1988, but India adopted it in 1999. In this section, a brief explanation about Basel II norm is given. Basel II was issued in 2004. This framework is based on three parameters. That is, these three parameters are known as three pillars. They are minimum capital requirement. It is to address the risk, and second one is supervisory review. Third one is market discipline. The first one, minimum capital requirement. Bank should continue to maintain a minimum capital adequacy requirement of 8% of risk-weighted asset. However, the definition of capital adequacy ratio was defined also. Basel II divides the capital into three. That is, Tier 1 capital also included in the definition or in the Basel II norms. This capital adequacy ratio mainly includes the good capital. Capital adequacy ratio is the ratio of good capital to the risk weighted. This good capital includes Tier 1 and Tier 2 capital. This earlier in Basel I, Tier 1 and Tier 2 capital were used, but in the Basel II norm, one more tier of capital was incorporated, namely Tier 3 capital. And this Tier 3 capital includes short-term subordinated loans. Subordinated loans means lower in the ranking. It is repaid after other debt in case of the bank liquidation. That type of the loans were also introduced in the Basel III Accord, and here the norm is 8% itself. Then it mainly deals with the credit risk, operational risk, and market risk. And the second pillar is with respect to the supervisory review or regulatory supervision. According to this, banks were required to develop and use better risk management techniques in monitoring and managing all the three types of risk. That is credit risk, market risk, and operational risk. That is, the banks were required to develop and use better risk management techniques in monitoring and managing all the three types of. This is the second pillar of the Basel II, and third one is market discipline. This means the increased disclosure requirements. That is, banks need to mandatorily disclose their capital adequacy ratio, that is risk exposure, etc., to the central bank. That is, disclosure of the status of capital adequacy ratio is the third norm, and presently India follows the Basel II norms. This about the Basel II. It was introduced in 2004, and it is based on three pillars. That is, three pillars are the minimum capital requirements, supervisory, and market discipline. The minimum capital requirements is the requirements of this is about the maintenance of capital adequacy ratio. It aims at 8% itself, but it included one more capital, that is capital Tier 3 capital. It's short-term subordinated loans, and the second one is regulatory supervision. And as per this is the and use better risk management technique. Third one is disclosure about the capital adequacy statement of the banks. These are the three pillars of the Basel 3-2 norms, and India follows the Basel 2 norms presently. And the next one is Basel 3 norm, and this was introduced on the background of the financial crisis 2007-8, and accordingly there was a need to strengthen the Basel norms, and Basel 3 norm was issued in late 2009. The guideline aims to promote a more resilient banking system, and the capital adequacy ratio is to be maintained at 12.9%, and the minimum Tier 1 capital ratio and the minimum Tier 2 capital ratio have to be maintained at 10.5% and 2% of the risk-weighted assets respectively. In addition to that, the banks have to maintain a capital conservation buffer of 2.5%, then counter-cyclical buffer to be maintained at 0.25%. The leverage ratio has to be at least 3%. The leverage ratio is the ratio of the bank's Tier 1 capital to the average total consolidated assets. These are the major changes introduced in the Basel 3 terms. Capital adequacy ratio 12.9, Tier 1 capital requirements 10.5, Tier 2 2%, then capital conservation buffer 2.5%, counter cyclical buffer 0.25%, leverage rates 3%. And Basel 3 also some changes were introduced. They mainly include, first one about the liquidity. Basel 3 created two liquidity ratios, that is LCR and NSFR. LCR is the liquidity coverage ratio, and this liquidity coverage ratio will require banks to hold a buffer of high quality liquid assets sufficient to deal with the cash outflow encountered in an acute short term stressed scenario. The minimum LCR requirement will be to reach 100% on 1st January 2019. This is to prevent the situation of bank failure. That is, the first one is about the liquidity coverage ratio, that is to hold a buffer of high quality liquid asset. Second one, net stable fund rate. Net stable fund rate means that it requires bank to maintain a stable funding profile in relation to their off-balance sheet assets and activities. This is about the liquidity. Two more liquidity ratios were introduced. This is to strengthen or in order to reduce the risk associated with the banking business. One is with respect to the liquid assets, sufficient liquid assets. Second one is with respect to the assets and activities, stable assets and activities. The deadline for the implementation of Basel 3 was March 2019 for India, but it was postponed to 2018, and in this situation, or in the light of the coronavirus pandemic, the RBI decided to defer the implementation of the Basel norm for further 6 months. And the Basel 3 mainly aims to improve the banking sector ability to absorb ups and downs arising from the financial economic instability. We have seen the situation on the ground on which Basel 3 was introduced, and to improve the risk management ability and governance of the banking sector, strengthen banks' transparency and disclosure. These three are the important in accordance with have introduced some changes, that is the improved banking sector ability to absorb ups and downs. Second one, improve risk management ability and governance. Third one, strengthen banks' transparency and disclosure. And we have seen some changes were introduced in the Basel 3, especially with respect to the liquidity buffer, capital conservation buffer. A short description of this one are given here. This better capital quality. One of the key elements of Basel 3 is the introduction of much stricter definition of capital. Better quality capital means the higher loss absorbing capacity. This in turn will mean that banks will be stronger, allowing them to better withstand periods of stress. This is to avoid the problems of the stress, that is better capital quality. Second one is capital conservation buffer. Another key feature of Basel III is that banks will be required to hold a capital conservation buffer of 2.5%. The aim is to build conservation the aim of keeping conservation buffer is to ensure that banks maintain a cushion of capital that can be used to absorb losses during the period of financial and economic stress. This also to meet the financial failures. The third one is counter-cyclical buffer, and it was introduced with the objective to increase capital requirement in good times and decrease the same in bad times. The buffer will slow banking activity when it overheats and will encourage lending when times are tough. The buffer will range from 0 to 2.5%, consisting of a common equity or other fully loss absorbing capital. This is also to meet the banking failures or the bank runs. Another one is minimum common equity and Tier 1 capital requirements. The minimum requirements for common equity, the highest form of loss absorbing capital, has been raised under Basel III from 2 to 4.5% of the total risk weight. The overall Tier 1 capital requirement consisting of not only common equity but also other qualifying financial instrument will also increase from the current 4 to 6%. That is minimum requirements from 2 to 4.5, Tier 1 capital from 4 to 6%. Although the minimum total capital requirements will remain at the rate of 8%, yet the required total capital will increase to 10.5. That is 4.5 here and 6% here, 10.5. This is minimum capital requirement will be 8%, but total capital will increase by 10.5. And some other changes introduced are the leverage ratio. We have seen two liquidity ratios were introduced, and in the leverage ratio also there was introduced some changes. That is, a review of financial crisis 2008 has indicated that value of many of the assets fell quicker than assumed from the historical experience. The Basel III rule include a leverage ratio to serve as a safety net. That is, this due to the financial crisis 2018, the value of many of the assets fell more speedier than expected, and therefore Basel III included some safety nets. A leverage ratio is the relative amount of capital to the total asset. That it is not to the risk weight, whereas it is the relative amount of capital to the total asset. This aims to put a cap on swelling of leverage in banking sector on a global basis. 3% leverage ratio of Tier 1 will be tested before the mandatory leverage ratio is introduced January 2018. This is also to maintain a good capital with the bank. Second one is liquidity ratio. Under Basel III, a framework for liquidity risk management will be created. A new liquidity coverage ratio and net stable funding ratio are to be introduced in 2015 and 18 respectively. Systematically important financial institutions. As part of the macroprudential framework, systemically important banks will be expected to have serving capacity beyond the Basel III requirements. Option 4 implementation include capital surcharge, contingent capital, and bailout in debt. And Basel III, which is to be implemented by banks in India as per the guidelines issued by the RBI from time to time, will be challenging task not only for the banks but also for the government of India. Here, what is the impact? What will be the impact of Basel III in one? It is estimated that banks will be required to raise 6 lakh crores in external capital in next 9 years. Also, by 2020, expansion of capital to this extent will affect the return on equity of these banks, especially the public sector banks. Indian banks have maintained their core and overall capital well in excess of the regulatory minimum. Therefore, the problem won't be that much. We have enough regulatory minimum with the bank. In this section, a brief explanation of different Basel norms are given. That is, we have already completed three Basel norms, Basel 1, 2 and 3, and various changes introduced in Basel 1, 2 and 3 are also explained.